Hi, I'm Jimmy. In this video, we're looking at the state of the US economy. We're going to look at different economic indicators to see how strong the US economy really is, and ultimately try to answer the question, do we invest now or should we wait for the stock market to pull back again? Okay, so let's jump into our first economic indicator, one that's been in the headlines a lot, that is inflation. So inflation has clearly gone quite high. This chart goes all the way back to the 1990s, and inflation's the highest it's been in that time period. Although recently, the past couple months, we have seen a pullback in inflation, which is a positive sign. But I think to get a more well-rounded look at inflation and wages, I think it makes sense to look at wage growth. So both of these numbers are looking at the growth year over year. Inflation measures the increase of the cost of goods and services on a year-over-year basis. How much are they this year versus how much they were last year? Wages do the same thing. How much are people making on average on an annual basis this year versus last year? And we can see wage growth has jumped with inflation, and this is a positive sign. But the real interesting part here is just recently, wages have crossed over inflation. So inflation dropped from about 9% down to about 5%. Wages stuck above that level right around 6 or so %. So this is a good sign for wages. Okay, now let's jump over to our economic scorecard. On our economic scorecard, I think although inflation has pulled back, and that's a positive sign in general, it's still way too high. So I think we got to keep this point for the bears. But wages, on the other hand, are looking quite strong. They've continued to be strong, which I think should give the Federal Reserve enough firepower to continue to at least slightly increase interest rates, which for wages, that's a positive sign. So the bulls get a point for wages, the bears get a point for inflation. Okay, so our next economic indicator is a very important one, and that is consumer confidence. The way that the consumer spends is one of the primary drivers of the US economy. So when we look at the history here, we can see that the current level of consumer confidence is actually quite low relative to history. So although we've seen a minor jump up in consumer confidence in the past few months, it is still, compared to the past 20 years, at near the lowest levels. So when we jump over to our economic scorecard, I do think it makes sense to give this point to the bears. Now, one of the reasons that the consumer is probably doing a little bit better over the past few months is when we jump over to our next economic indicator. This is the U3 unemployment rate. Well, the unemployment rate, U3, U6, all of the unemployment rates have continued to trend lower, which we can see that in the wages number. We can see that in consumer confidence. And overall, I think we have to admit that a declining unemployment rate is probably a good sign for the broader economy. So jumping back to the economic scorecard, I think it's only fair to say that the current level of unemployment is a bullish point. This is a sign for the bulls. So right now we're tied up at 2-2. Okay, so our next economic indicator is one I'm a bit questionable on, and that's household debt. So we can see that, broadly speaking, household debt has trended lower, which is a good sign. But this chart, just to note, this chart goes all the way back to 1973. So this is 50 years of data. Relatively speaking, household debt is kind of high right now compared to the past 50 years. But in the past 20 years, it sort of trended lower. Now, when we jump over to the economic scorecard, well, I actually gave this point to the bulls, but I've debated with myself for a while about whether or not it should really be a point for the bulls or should it be sort of a neutral point. The reason I gave it to the bulls is in the past 20 years, interest rates are significantly lower now than they were, let's say, back in the 1970s. So in theory, lower interest rates would inspire more debt. So I'm not too surprised that the level's higher today than it was back then. But feel free to try to talk me out of it. If you think this should be a neutral point or perhaps even a bearish point, let me know in the comments below. This is one of the few economic indicators that I could probably be talked out of. Okay, now let's jump over to the manufacturing sector. So this is a chart of the ISM Manufacturing Economic Indicator. And the most important level here is 50. Anything above 50 implies positive growth for the manufacturing sector. Anything below 50 implies negative growth for the manufacturing sector. We can see right now it is below 50. It's been below 50 for a few months. So clearly, this is a negative sign. Now, when we jump over to the economic scorecard, clearly this one's an easy one. This is a clear point for the bears because manufacturing continues to struggle. Okay, now let's jump over to the housing market. So our first economic indicator is the price of existing home sales. Now, the interesting part about this one is we can see that overall the trend is higher, and this actually makes a lot of sense. Over time, housing prices should go up, although with COVID, everything sort of jumped excessively. Now, there has been a pullback in the past couple months of housing, but a lot of that might just be the correction of what happened with COVID. So I'm not sure I can say that the pullback in house prices is necessarily a bearish point, although it's probably some seasonality as well, and the increase in interest rates, therefore higher mortgages. But just to double check ourselves, another economic indicator that we can look at with housing is something known as housing starts. This is the number of new houses being built. And here we can see a clear break of the trend on the downside. This implies this is a negative sign for housing in general. And I think in my mind, this at least clears it up a bit. There's less houses being built, which is probably a bad sign for the housing market and ultimately the broader US economy. So the pullback is going to give this point to the bears. So jumping back to the scorecard, another point goes to the bears. Okay, now we've got probably our most important economic indicator, and that is the US Treasury yield curve. So the US Treasury yield curve is one of the most accurate predictors of the economy, not the stock market, but the economy for like the past 100 years. Now, when we look at this, for anybody who knows much about the Treasury yield curve, we'll look at this and say this is an automatic slam dunk point for the bears. This is a bad sign. Because the way it's supposed to be is the shape of it is what's most important. Right now, it's like this. It should be like that. Basically, what we're looking at is a measure. So there's 3 months, 6 months, 2 years, 5 years, 10 years, 30 years. What interest rate would we get if we borrowed money or if we lent money to the US government for each of those time periods? Right now, we would get more money. We'd get a higher interest rate if we lent them money for 3 months versus if we lent them money for 10 years. That is not the way it's supposed to work. The economy, the banking sector, economics in general require that you borrow money at short-term rates, lower short-term rates, and you lend it out at longer-term rates. That is why the shape is supposed to be very different. Now, out of all the times in history that the yield curve has inverted like this, nearly most of them have been followed by a recession. To put it another way, we've never had a recession that wasn't preceded by an inversion of the yield curve. So again, when we jump over to our economic scorecard, this is an easy point for the bears. Now, I realize you can't really see the bear point. There it is, bear point down there. Can you see it? Woo! Sorry about that. Okay, so I'm standing in the way of the point, but trust me, there is 5 points for the bears and 3 points for the bulls. These are really pointing to the likelihood that a recession is certainly inevitable at this point. And I think broadly speaking, this has been widely accepted by much of the economic community. Although to answer the question, do we invest now or wait? I still don't see why the possibility of a recession would be a reason not to invest. If anything, it's a reason to invest more strategically, but not necessarily a reason not to invest at all. So if you are looking to invest, I would consider sticking with value, long-term value. Look for opportunities that perhaps the price is down because of the current economic environment, but over the next 5 years, 10 years, 20 years, this company should do quite well. If we do that, I think our portfolios could really outperform over the next decade or two. Now, if you're not feeling terribly confident with that type of thing, we actually do these private investing live streams. What we do, we're building different portfolios. We value a bunch of different companies. We do research projects together. If you'd like to join us on any of those, I will leave a link in the description below as to how to join the community, get access to all of that. Besides that, thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.